So here's a question. How did the world's most powerful economy, America, nearly destroy itself in 2008? Banks collapsed, people lost homes, jobs, and savings, and all because of bad mortgages? It sounds crazy, but the 2008 financial crisis wasn't just about housing. It was about greed, complexity, and a chain reaction that nobody stopped in time. Let's break it down. Section 1. The housing bubble. It all started with one word, housing. In the early 2000s, buying a house in America seemed like a guaranteed win. Prices kept rising, banks were giving out loans like candy, and everyone believed home values would never fall, so people borrowed more than they could afford. Banks approved it anyway, and investors poured billions into the booming housing market. That's called a bubble, when prices rise not because of real demand, but because everyone's betting they'll keep going up. Section 2. Subprime mortgages, the bad loans. Banks weren't just lending to safe borrowers anymore. They started lending to almost anyone. These risky loans were called subprime mortgages, given to people with weak credit, little income, or no proof they could pay. Why would banks do that? Because they didn't plan to keep the loans. They sold them off. Section 3. The Great Securitization Scheme. Here's where it gets complicated and dangerous. Banks took thousands of home loans and bundled them into giant financial products called mortgage-backed securities, MBS. Then they sold these to investors, pension funds, insurance companies, even foreign governments. The pitch was, it's safe. People always pay their mortgages. Ratings agencies even gave these products AAA ratings, the same rating as US Treasury bonds. Spoiler, they were not safe. When homeowners started missing payments, the entire chain began to crack. Section 4. The domino effect. Once housing prices stopped rising, the bubble popped. Homeowners couldn't sell or refinance. Defaults skyrocketed. Those safe mortgage-backed securities turned out to be toxic. Banks realized they were holding billions in worthless assets. Investors panicked. No one knew who was still solvent, so everyone stopped lending to everyone else. That's when the credit markets froze. Even healthy businesses couldn't get loans. Companies cut jobs. Consumer spending collapsed. Section 5. The Fall of Lehman Brothers. Then came the breaking point. Lehman Brothers, a 158-year-old investment bank, collapsed under $600 billion in bad debt. The government let it fail, thinking the market could handle it. It couldn't. Panic spread globally overnight. Banks in Europe started falling. Stock markets crashed. Trillions in wealth vanished in days. Section 6. The Aftermath. Global Recession. Within months, the US lost millions of jobs, foreclosures hit record highs, and economies around the world slid into the Great Recession, the worst downturn since the 1930s. Governments scrambled to respond. The US launched massive bank bailouts and stimulus programs. Central banks cut interest rates to zero, and new laws like Dodd-Frank tried to tighten regulations on risky lending. It worked, slowly, but trust in the financial system was shattered. Section 7. The real causes simplified. So what actually caused the 2008 collapse? 1. Easy money. Low interest rates made borrowing cheap. 2. Greedy lending. Banks handed out risky loans for profit. 3. Toxic securities. Those bad loans were disguised and sold as safe investments. 4. No oversight. Regulators looked the other way. 5. Overconfidence. Everyone believed housing prices could never fall. It was like a global game of musical chairs, and when the music stopped, millions were left standing. Section 8. What we learned and didn't learn. The world learned the hard way that markets can't always police themselves. Today, banks hold more reserves. Lending is stricter, and oversight is tighter, but risky behavior never disappears. It just changes shape. Some say the next bubble might be in tech stocks, crypto, or government debt. The lesson? When people start saying, this time, it's different, it's usually not. In conclusion, so what caused the 2008 collapse? A perfect storm of greed, bad bets, and blind faith that the system couldn't fail. But it did. And it nearly took the world down with it. Because when too much money chases the illusion of safety, the crash always comes. Like, subscribe, and in the next video, we'll explain how the world fixed the crisis and whether it could happen again.